The strength of the U.S. economy is becoming increasingly dependent on its wealthiest households. And according to Moody's Analytics chief economist Mark Zandi, the top 20% of American earners now account for nearly 60% of all consumer spending, up from 50% during the dot-com boom. Well, in the year ending the first quarter of 2026, spending by households earning more than $200,000 annually rose 6.5%, or roughly 4% after inflation. Now, by contrast, inflation-adjusted spending by the remaining 80% of the households was virtually unchanged. The trend suggests economic growth is increasingly being supported by a relatively small group of affluent consumers. While much of this spending strength is being fueled by rising stock market wealth, nearly 90% of corporate equities and mutual funds are owned by the top 20% of income earners, meaning higher asset prices have significantly boosted their purchasing power. Economists describe this as the wealth effect, where rising financial wealth encourages greater spending. However, Moody's warns that this growing dependence also creates a vulnerability. Valuation measures including price-to-earnings multiples are approaching levels that suggest parts of the market may be overvalued. While headline economic indicators remain resilient, the benefits are not being shared evenly. Moody's says the U.S. continues to resemble a K-shaped economy, where affluent households continue to prosper while much of the middle class struggles with affordability. Separate Congressional Budget Office data show that if middle class incomes had grown in line with overall income growth since 1979, households would be earning roughly $30,000 more annually before taxes. Analysts say the widening income gap has become a key driver of affordability concerns, making consumers spending and the broader economy increasingly reliant on the financial health of the wealthiest Americans.